Hi, hello, good morning, everyone. Uh, so just thinking about as the alternatives industry where we have reached, and uh, thought it's a good time to take a step back, just as this opening session to set the context. And essentially, the context is that for the long-term growth story of this country, and you're talking about an economy which hopefully will go from 3 to 5 trillion in short order, and one of the largest economies in the world. What is the biggest drivers of growth is the ability to channelize long-term capital into sort of productive opportunities. In India, we've never had really a challenge in terms of opportunities. We've had a massive, bottom-up growth culture. But where we've already struggled in the past has been, how to channelize our domestic savings into these opportunities. The domestic investors have traditionally been more sort of risk averse, preferring debt oriented investments. They've uh, preferred direct investing into physical assets, land, gold, etc. Some of the heavy lifting on providing that long term risk capital as a result went to the government, it went to foreign investors, it went to the big conglomerates who had sort of ability to juggle capital from one venture to another, or had the ability of their parent brand to be able to raise money. But otherwise, you know typically we were a capital starved economy, and the big sort of inefficiency in our growth model was that we could not match these two. And that's where I think the last 10 years we've seen this pretty dramatic transformation, where the alternatives industry has taken this massive step up. And we've now really, as an industry, serving this very, very important need for the economy, which is matching uh, long term savings, risk seeking capital, with opportunities which are being thrown up by this rapid growth that the Indian economy is going through. um, we also have, of course, side by side maturing of the the markets, the regulatory ecosystem. I say 10 years because 10 years ago is when we had, of course, the AIF regulations come in from SEBI. We also have in these 10 years seen a massive switch from savings, which are more traditional, to capital market oriented savings. We've seen a massive boom in mutual fund inflows, for example. So it's been an all round situation where there's been a level of maturity which is coming in terms of the economy. And that's the context in which the alternatives industry has also taken root and is benefiting from. Of course, as you see, where the hat of the saver, the Indian domestic households, for them, of course, the big driver has been looking for choice, as they have migrated from traditional debt to listed equity to looking for other sort of non-correlated asset classes, and alternates has the power to provide that. But I think the big message really for me has been that we have always been throwing opportunities, the Indian economy. It's just that these opportunities traditionally have gone to the deeper pockets, the savvier investors, which have typically been the global investors. And this is now the first time, perhaps, where we have the ability to sort of uh, use a lot of our domestic savings to benefit from to which can benefit from these opportunities. And the risk adjusted returns are going to be fantastic, so that's sort of a win-win for both sides. If you look at, therefore, what that has meant in terms of numbers, um, it's been a situation where um, uh, we've seen a pretty explosive growth in AIF launches, in terms of AIF commitments that have been collected. And it just is reflective of, as I said, the coming of age of this industry. Effectively, what we have been able to do, and I think it's still a beginning of that journey, it's a long way to go, is I think we've been able to create effectively a marketplace or an ecosystem where uh, capital is trying to look for and match up with opportunity. And this marketplace essentially is what the alternates ecosystem is able to provide. The other big driver here, of course, is also the entry of domestic GPs, domestic investment managers who've come in these last 10 years. Uh, um, um, I would I would say broadly two categories of managers. One, of course, is the large domestic institutions, people like us, Axis, a bunch of others. But also, you've been seeing a situation where a lot of the uh, uh, um, uh, fund managers, investment managers, or investment teams have branched out and created their own GPs, their own managers, and that's been a massive growth driver as well. So this growth has been accompanied by these domestic GPs, which have really been much more nimble. They have a much better understanding, I believe, of the local nuances, of the local opportunity matrix. They have a much better understanding of what the local investor needs, and are therefore able to create products, create opportunities that can fit these requirement, the investor requirements with the market opportunities. And that's really that been, I think, the biggest sort of uh, piece that we've seen here, which is essentially innovation. That domestic GPs have come in, they have been able to innovate, they've been able to create new product categories, new ideas, and those have really seen a lot of participation from domestic investors. What's also helped, of course, is that in the last 5 7 years, some of the early entrants have been rewarded. So I feel, I mean, data is a little patchy for the alternates industry, but we've started seeing some data coming through from some of the service providers who started collating aggregate data. And if you see funds which were from the early vintage 5 7 years ago, I think on a broader basis the performance has been quite good. So the early movers, the early investors who've come in 7 years ago, 5 years ago, have been rewarded. And obviously, that has given rise to a lot of confidence for them to keep sort of allocating into this space and benefiting from this opportunity. Talking of innovation, I think if you look at the different categories that are available and are on offer within the alternative space, I would draw upon maybe two or three big ones. I think the unlisted equity, which is essentially the growth capital, as well as listed plus unlisted, which will combine growth to sort of pre-IPO that journey. And I think that has been sort of the big driver of growth from domestic GPs and domestic investors. As success in the listed equity space, and also the huge success of the startup ecosystem, especially the tech driven one, has given rise to a lot of opportunities, and also a desire to go backwards from the listed to the pre-listed or late stage investing. And I think that's been a big source of growth for this space. um, of course, venture capital continues to grow. That's still, I would say, a space which is slightly more niche, but again, the startup ecosystem, the vibrancy of just the sheer number of launches that we are seeing is helping there. Um, One area which sort of remains a little bit of a tricky one is real estate. We've seen a lot of innovation, a lot of attempts, including for us at Axis. We've sort of done a few things which were first to market, etc. But I think there's a huge legacy of baggage of 20 25 years of challenges, which are still sort of playing in investors' mind, and I think sort of coming in the way of structured allocations. Having said that, I think the environment has changed, regulatory situation has changed, and I think the with the listing of REITs and with some of the regulatory changes, RERA, etc., we are on the cusp of a big change in the real estate system as well. Especially if you look back at the sort of household savings allocation, real estate land does tend to be a big part of the savings pie. So as this financialization takes place, I think you will start to see some of that flow through into the alternates ecosystem as well. Um, Finally, I think the listed equity and the long short funds or the hedge funds, um, while I will say that in a percentage sense, it looks like the allocations come off, but in an absolute sense, we have seen good growth as sort of a lot of the 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 senior fund managers. We've seen a trend where they've started their own setups, their own boutiques. We've seen innovation in the form of quant long short strategies coming in, multi-asset strategies coming in, and all of that is laying the stage for, I think, a good growth in those categories going forward as well. If you see it from the other side in terms of the investor context, a lot of the HNIs and family offices are uh, well on their way in terms of taking this journey of investing into AIFs. If you see the intent, I think there is a clear intent for most family offices today to be present and be, in fact, very active in the alternate presence. In fact, the whole genesis of the fact that today families, instead of investing on an ad hoc basis, the fact that a lot of them are choosing to create these family offices, choosing to create these structured mechanisms where they can participate and benefit from this opportunity is a huge benefit, huge sign of how seriously they want to look at this space. So we have a number of examples where, in fact, the family offices have chosen to hire senior investment professionals who also are happy to do direct deals, who are happy to sort of partner with alternate investors, GPs, and who are, of course, looking to make blind pool investments. So this is a big area. One thing, of course, which I will add is that uh, uh, there is an element of move towards opportunities which are more familiar or which have more market buzz. So uh, one of the things which we've seen in the last 3 5 years is that the whole growth and startup and that tech ecosystem and the buzz that had, which obviously was driving a lot of allocations and flows into that space. So if you see the biggest area, private equity tends to be a big area where that allocations have come through in the last 3 5 years. The other sort of interesting one for family offices I would also call out is hedge funds. A lot of them are looking at sort of non-correlated or downside protected strategies, and I would add probably credit into this one as well. So credit and hedge funds play that very important part where family offices who are sitting on a certain amount of large pools, how are they able to create structures which give them a reasonable experience and sort of downside protection or lack of correlation, especially when we see sharp moves from equity markets or equity oriented products. And I think this is a trend that is, we've seen this globally. People, one of the big reasons people come into alternatives is to have those non-correlated asset classes, non-correlated returns and risk. And I think that's probably one of the reasons. If you go back to the previous one, while credit currently is a smaller part of this industry and hedge funds are a smaller part of this industry, but both of these are spaces which, given the interest of family offices, I think over time can have a big one. Of course, one context, as we all know, is taxation, which plays a big part in India. And both of these categories, credit and hedge funds, we know are challenged in terms of their taxation today. But hopefully these things will get streamlined over time, and I think both of these are ripe for massive growth and interest from family offices. Talking about what this does to investor portfolios and just the power of this diversification that alternates provide us. We just took some data from a global market context. I mean, still not enough rich data in the Indian ecosystem for us to draw upon. But if you look at how these things have played out in the global market, what we've seen is that typically allocation to alternates has a pretty strong positive effect in risk adjusted return. And what that means, as we all know, is we can play it in two ways. For those investors, family offices who want to dial down on risk but still have return aspirations which they want to meet, that's one way of playing it, where you use this to manage it in that manner. or the other ways for like to like risk can you sort of optimize your return and improve your return profile. And again, this can be, so it can be done in both ways. And I spoke about the power of strategies which provide downside protection or more sort of regularity of income, or more lack of correlation with equity and fixed income market movements. And these are all asset classes which are already there. In fact, we have these upcoming asset classes as well, which I should mention. Like commodity. We have got logistics. We've got. I spoke about the commercial real estate. We spoke about hedge funds, long short. So a bunch of these new upcoming, and they all have this power of being able to provide these allocation opportunities which family offices can benefit from. So with this context, what's the road ahead now for the alternates industry as we look ahead maybe over the next 5 to 10 years? Um, I think the first thing is that after, of course, some very heady good years in the last 10 years, I think 22 was a little bit of a check in terms of, especially I said the biggest area of this industry, which is, let's say, growth investing, and a lot of that money went into tech. And given what we have seen happening in the tech system, that's been a little bit of a pause for thought, people some sort of sort of thing to sort of mull over. And we have uh, quite a lot of people who are still, while I wouldn't call this anything more than a worry right now, but a lot of people are worried who have allocated to this space, people who have allocations, money in the entire ecosystem. And this is probably going to be one of our first sort of big tests for this sector as we have grown and become large. It's probably going to be how we come out of this whole space in the next 2 to 3 years will be a big test. Uh, Having said that, I think if we take the big picture, I'm not too worried. If you look at in terms of just the way the market is responding to these trends, lots of and I'm just going to focus more on the tech ecosystem because that's where the big sort of question marks have arisen. And what we are seeing is that there is a lot of soul searching within founders, within investors. There's a lot of pushback on sort of business models, on projections, on profitability targets. um, of course, some of this is also to do with the fact that we had some pretty unusual 2 or 3 years thanks to COVID, when the entire tech ecosystem got a massive bump up in terms of their growth rates. And as they are now struggling to adjust to a more normal environment in a post COVID sense, some of this is sort of playing out in terms of lower growth rates, etc. But having said that, I mean, just anecdotally, we were talking to sort of people in the ecosystem and just understanding how things are reacting. And sort of very crudely speaking, what one hears is that a lot of, I mean, every single company is talking about path to profitability, and some of the just basic parameters, like if you see EBITDA burn and stuff like that, there is a massive cut down today if you look at the last quarter versus where companies would have been 12 months ago. In fact, anecdotally, they'll probably, in most cases, the companies are talking about probably halving or even further reducing their EBITDA burn in the last 12 months, in an environment, of course, where growth has cooled off as well. Uh, but yet remains very, very attractive. So we are not, when we say growth has cooled off, we got used to seeing 100% kind of growth rates in COVID era, and that's sort of maybe settling down to more like 30, 40, 50% depending on the company. There's still very, very attractive growth, but in an environment where you can try to make it more sustainable. As a result, I think deal activity has continued to be okay. I think the opportunities are opening up. The market was pretty locked up for last 6 9 months, but we are seeing a situation where a lot of investors are seeing very interesting deal making opportunities and are stepping up. And these include, of course, both domestic GPs and global. One of the benefits of having a large system now of domestic GPs is that we can tune out some of the noise that comes from the global markets, which does sway sentiment for global investors, and we can take some pretty bottom up specific allocation views basis our own views here. And that's, I think, a very important healthy development for the market. um, as a result, if you see deal making, what the data suggests, I think, of course, 22 you did see the cool off, but it doesn't capture the full effect because we did start 22 in a very, very positive way, some of the follow on from 21. 23, of course, should see a probably a further cooling down, but also a bottoming out and stabilization of this market. And I feel that while, of course, just like any market, you will have winners and losers, on balance, we will find that the opportunity was very real, the growth was very real, and given enough time, a lot of these companies are going to generate wealth, which is going to be very real as well. I think the companies are also using this opportunity to get better at getting ready for their eventual path to listing. So we are seeing a lot of effort being made to clean up cap tables, to improve governance, to get ready for the disclosure and the spotlight of a listed market, which maybe perhaps the first wave of companies perhaps could have done that better. And I think the next set of companies we'll find are much better prepared, are much better sort of ready to be able to go through that journey. And I think in the therefore the 2 3 year, it's in a sign of maturity of the market, and in 2 3 years sense we will see a much better outcome for some of these investments than we have seen in the past. One of the other big sort of development has been uh, uh, the whole area of co-investing, and this is again an area for the future where essentially some of the very, very large family offices, some of the very large institutional investors are not happy just sitting in the blind pools, and they want to really become partners with GPs. And we are seeing very active conversations where they want to sort of talk about how they can work together with the investment managers in a much broader sense, whether it is co-investing, whether it is working together in advisory committees, working together on deal opportunities in whichever form or shape. And in many ways it's a win-win, because for the GPs, for the investment managers, it allows you a much more dry powder, allows you to shoot for bigger deals, allows you much more flexibility, and for the family offices and investors, it allows them to look for a lot of additional opportunities which they may or may not have gone on a pure play blind pool basis. So this is again a trend to keep mind of. And finally, what are some of the sort of additional points that the industry needs to work on as we continue our growth and get into a level which is more mature? I would call out maybe sort of 3 or 4 big areas. I would say first thing that really hurts this industry is a lack of transparency. I think the regulators taken note of it and is forcing all of us to be much more sort of transparent in the way we show performance, in the way we show some of our positions. But I think a lot more can be done to gain the trust of investors. Um, there is also a lack of market depth. While I kept saying during my talk that the industry is maturing, the reality is that we are still a very, very, I would say, shallow set of investors, in the sense that typically when we get swayed, all investors tend to get swayed on the same side. So you had a scenario where 2021, early 22, there were only buyers for certain opportunities, and today there is a scenario where nobody wants to buy the same opportunities, even though some of the terms could be far better. So we can't have such situations. You need to have deep markets where you have different investors who are happy to look at. And I think the horizons can be different, the risk returns can be different. And one of the things about getting to a more stronger, healthier market is to have a presence of different investors who are able to take different calls like that. um, Ongoing regulatory changes, I think, will be an issue. I think over the weekend we had a bunch of new things. One of the big areas, I think, again, regulators worried about is sort of exits on some of the old positions. We've had situations where some of these older funds have dragged on and we've not been able to give a final exit to investors. I think exit discipline is going to be a very, very important part of success for this industry, and that discipline will be needed. Of course, we've seen the regulator step in and provide some additional sort of work for us to think about, but as an industry, we will have to do some of this ourselves as well. Um, I think one of the maybe final points is also that we will need a much more. We've already seen this, but we need much more presence of long-term institutional capital. And again, I say domestic. So insurance companies, pension funds, some of those sort of investors who are knowledgeable, who have the risk capital to give long-term allocations, and I think that will make a huge difference to this industry as well. Because again, I go back to this illiquid points about my, about the market, and whether we like it or not, family offices and sort of the HNI investors will be a little bit swayed by the near-term market trend, and some of the institutional investors can provide that counterbalance and help sort of manage the market illiquidity a little bit. So these are some of the things for us to work on as an industry, and sort of as we grow further. But despite some of these challenges, what remains very clear is that we are going to see a pretty continued growth, because the opportunity is very, very large. As I mentioned in the opening remark, the risk adjusted return that the Indian economy throws up is very, very attractive, whether it is whichever asset class we take. It's real estate, it's commodities, it's growth ecosystem, the new venture ecosystem, it's credit ecosystem. And as long as that all the opportunities keep getting thrown up as the economy keeps growing, I think there is money to be made, and there is a benefit that investors can draw from that. So with that, I'll pause here, and I think there's a very, very bright future for the alternates industry in the next 5 to 10 years. Thank you. Maybe we have time for a quick 1 or 2 questions if anybody wants on any of the points I made.
Hi, thank you for that. My name is Beena Trivedi. With regards to the regulatory disclosures, etc., SEBI is going across to all funds via CRISIL, if I'm correct, collecting data on the funds. And I'm not sure how this is going to be used or publicized or otherwise. I do not know the details. But this asset class per se bases all of your interactions and bases your personal view. Do you think it lends itself to a retail mindset at all? And to that extent, does it behoove this kind of data to be made public or otherwise? And one can do what Cambridge Associates does in terms of quartile performance, etc., which does not give out details, which is an education process and an information process. But otherwise, garnering individual fund data and then disclosing it could have both positive and negative ramifications. And how do you think that will play out?
Yeah, so great point, and I think 2 parts to that. One is the way we use this data is that in all of our PPMs now we have to put in comparable performances to our funds, and this is the data that, as you mentioned, CRISIL and a couple of others do in terms of collating like to like. I think they do a reasonable job in terms of making sure that they pick funds which have similar strategy, similar vintage, etc., so that the data is more useful. Of course, there are nuances there, and we can always sort of keep nitpicking a little bit. But I would argue that more transparency can never be bad, right? It's also for us as an industry to educate investors to understand how to read that data, how to make sense of what it is. But we can never sort of argue that this data disclosure is not going to be good because people won't understand. So I would say it's a great initiative by the regulator to get the industry to come together and put some common data points. But to your other point, yes, that's where I think the whole sophisticated investor framework comes in, which is true globally. In India also, as we all know, AIFs have been limited to 1 crore and above for the same reason that SEBI feels that somewhere for people this is slightly a complex instrument, and as investors, people should have the wherewithal either to understand this on their own or to employ advisors or sort of wealth managers who can do this for them. And I think that's again sort of a part of growing up of this industry. We saw this in mutual funds where for a much simpler product, it took us a long time to get people to understand how equity investing works, just to give an example. So I think it's part of the process. I do believe in using our own experience at Axis, the engagement we have with investors. Yes, some of them uh, uh, could be more sort of explained better in terms of the strategies, but a lot of them do understand it when they come in. It's not that they've come in without realizing what it is that they're signing for. So most of them do have that clarity. And I think in the last 5 to 10 years, as we saw in that family office chart, I think a lot of the larger investors have now experienced firsthand what it is like to invest into AIS, what are the pitfalls, what are, for example, things like liquidity, things like fees are today much better understood by most investors than probably 5 years ago or 7 years ago. Yeah. Yeah. Maybe one last question.
Hi, this is Bhavesh from Orias Venture Partners. What do you think is the feasibility of open-ended, funds?
So I think we've seen this globally where sort of this whole listed alternatives or sort of liquid alternates was a big thing that was tried in many developed markets. I'm not sure we have today the required market depth, honestly, to be able to do that. And I'm sure many of you have seen sort of what happened with the real estate funds in the UK, where there was some gating introduced by a number of funds earlier part, just last month, a couple of months back. And even there, when market shocks happen, they need the ability to sort of protect themselves. In India, I think the market is still very shallow, even for long gestation lock-in products. Trying to get exits is not the easiest thing, and I mentioned this point again, where I think the focus on disciplined exits becomes very, very important, I think, for everyone, because of this nature where the market is very one-sided. If you're in a good market, you'll get lots of buyers. If you're in a bad market, there are no buyers at all. And I think that till we get a way to come out of that liquidity, there's no point talking about liquid vehicles or listed vehicles till we have clarity or the market depth which can support those kind of things. Great. Thanks, everyone.